I've seen a number of estimates of the shortage of silver at the LBMA. One estimate said there's only 6 weeks supply ahead, and another one said there's 4 months, so that's quite a big difference. But the bottom line is, it does seem that silver inventories at the LBMA have been shrinking for years. And of course, what's left is going to be very much spoken for in terms of it's leased out or it's held by an institution which has no plans to ever sell it at any price. So when you have a situation like that, and if the demand continues to be higher than the supply coming in, and by the way, there has recently been a report, I haven't read into it, but a report of big shipments from America to London of silver. But if the supply is not coming in, you then get a kind of leveraged situation when people want silver, but it's in short supply, because the leasing rates at one point I heard were up to 40% a year. The size of the move that we've seen has been unprecedented. Having said that, unlike the bull market we saw when the Hunt brothers were buying silver and took it up to $50 back in I think the early 80s or late 70s, which was a speculative mania, this one is driven by fundamentals. We're seeing, we've seen for the last 5 years a deficit in mine production compared with the industrial demand. And that industrial demand is set to increase, partly from electric vehicles, where the amount of silver required is about double what you need for a conventional combustion engine. And of course, we've got an accelerating move towards solar panels, which also are big consumers of silver. So there's quite a large deficit in silver, and the only way to suck out that deficit is through higher prices. But obviously those prices have moved very fast, and that kind of makes it, at least in the short run, kind of speculative. It doesn't mean to say that the bull market is over, not at all. But often when these things happen, you do get a sharp and unexpected pullback before the bull market can resume and go to another all-time high. But if we were to take the speculative boom of the Hunt brothers, and I think there was another one a bit later, which wasn't so much speculative. But
silver's deficit isn't theoretical; it's driven by modern infrastructure. Electric vehicles require nearly twice as much silver as traditional engines, and global EV production continues to break records. Solar energy, now the world's fastest-growing power source, consumes more silver annually than most nations produce. With photovoltaic demand expected to reach new highs by 2027, supply pressures are compounding. Even data centers, AI hardware, and advanced electronics rely heavily on silver's conductivity. Without higher prices pulling recycled metal back into circulation, the gap widens. The shortage isn't temporary, it's structural, and it's reshaping long-term price expectations.
Both of them took silver to around $50, and so this time we've gone to $50. But if we adjust it for inflation, the figure I've heard quoted, and I haven't double-checked myself, is we'd have to go to $180 this time around to kind of make a peak similar to the ones we've had before. So, when you have large bull markets like this, they can often overshoot. So I'd be a fool if I said it's going to turn around tomorrow. I'm not saying that. It could easily shoot up again tomorrow and the day after. But at some point, when you've got this sort of move, there has to be a pullback. And I think from here on, it's not so much of a steady rise as we have perhaps seen over the last few years. We now go into a phase where the moves are more violent, perhaps 2 steps forwards, 1.5 steps back, 2 steps forwards, 1.5 steps back. And of course, if you're a person who doesn't feel he's got enough silver, the way to play the game is to ease in gently a little bit now, which is painful because you're buying at the all-time high, but keep some in reserve so you can buy some perhaps in 10 days or 30 days time. Might be higher, might be lower, but either way, you can't be sad that you paid everything at the highest price.
Parabolic rallies are rarely smooth. As silver pushes into uncharted territory, sharp pullbacks are not signs of collapse. They're natural pauses in a tightening market. Historically, metals entering bull phases behave violently, moving in rapid surges followed by deep retracements. Adjusted for inflation, silver would need to approach roughly $180 to truly match its early 1980s peaks, suggesting there is still significant runway. Traders should expect 2 steps forward and 1 step back, fast moves, sudden corrections, and unexpected reversals. This is not a market for all-in bets. It's a cycle built for strategic positioning and gradual accumulation.
First of all, I haven't studied the entire market as I did 3 or 4 months ago when I did that video that you have to buy silver miners. But I have been looking in the last few days at a number of the silver miners and revaluing them. The ones I looked at, I consider still to be very undervalued at today's silver price. I would say they're probably pricing at a silver price of $25 at the moment. Not $50, or now we're $57, aren't we? So if this price holds, and I think we'll have the up and down, but I think there's a floor in the range of 45 to 55 at the moment, and then we move up into the higher levels. But let's assume that range holds. Those silver miners are going to be on extremely or very low price earnings multiples next year, when we're talking about the 2026 profits, with probably a higher price than today's price. So in a doubling of the silver price from 25 to 50 doesn't mean to say the shares double. It means they do a lot more than doubling. So when I did my calculations on a number of silver miners, they all look like they got many multiples higher to go. And and you asked me to name some of them. Well, there's a lot I like. There's Majestic Silver, there's Pan American Silver, there's Silvercrest, Hecla. And by the way, I don't own many of these. I own 1 or 2 of them. Discovery Silver, Andean Precious Metals, which is gold and silver. Kingsgate Consolidated, gold and silver. Silver X is one of my favorites. It's a fairly new producer.
While spot prices capture headlines, mining equities may offer the most explosive upside. Many producers are still priced as if silver were $25, despite spot trading more than double that. If current price floors between $45 and $55 hold, miners could post dramatically higher earnings by 2026. A doubling of silver doesn't mean mining stocks double. It means multiples of that. Companies like First Majestic, Pan American, Hecla, Silvercorp, and Silvercrest remain positioned for significant expansion. Major producers may be safer, but select emerging miners could deliver outsized performance if they survive the volatility and funding challenges.
But it's got a very, very leveraged upside. That's been one of the best performers, but I think it's going to be an absolutely phenomenal performer going forwards. And this is not investment advice. It's just my personal opinion. I've done my maths my way with my assumptions about what the silver price was. And when I did the maths, I assumed the silver price would be $50 in 2027. That's a rather conservative estimate. It could be a lot higher. But I used a $50 price and worked out what will the earnings of these companies be in 2027. And if the earnings are that, and I put a price earnings ratio, a modest price earnings ratio, by the way, I used 10 times on these companies, where do I think the share price will be? Then I compare that share price with what it is now, and there's many multiples upside. Another one which I particularly like is called Silvercorp. That's a particularly good one. But you can't really go wrong if you buy the silver mining ETFs or the silver junior mining ETF. At this point, I'd probably go for the mainstream silver miners rather than the juniors, even though the juniors potentially have I'm going to say, like, lots of juniors have huge upside. The problem is lots do not, because they're going to run out of cash. So if you're buying individual companies, and this is what I would recommend to anyone who's trying to buy silver miners, unless they really, really know what they're doing, and I would say I know enough about juniors, but unless you really know what you're doing, you should stick with the majors and the ones which are either already producing or just starting to produce. Then you know what's coming out of the ground. You can do some maths on that. You can look at how many ounces they're producing and they say they'll produce. You can look at what the silver price is, what you think they'll get, and that's your number. You can put $50, $70, $20, whatever you like. And then you look at the cost per ounce coming out of the ground. And now you have a gross profit before other expenses. The other expenses are easy to see on the website, just deduct them. And you now have net earnings, divide that by the number of shares, and you've got an earnings per share. Multiply that earnings per share by the multiple that you want. I use 10 times, but lots of people might use 15 or 20 times. And you get to a future share price. If you can't do it yourself, get AI to do it for you. There's some very good AIs out there. Perplexity will do it. Grok will do it. Manus AI will do it. I'm guessing that ChatGPT will have a very good go at it, but ChatGPT, I'm finding, is sometimes a bit lazy and only does half the job, so I'm not really happy with it at the moment.
Assessing mining opportunities requires more than enthusiasm. Investors must analyze production rates, costs per ounce, operating margins, and forward guidance. With silver prices rising, companies with stable output become cash flow machines. A simple model, ounces produced minus total costs multiplied by a conservative price estimate, can reveal a miner's true potential. Even a modest earnings multiple of 10 can project substantial future valuations. Tools like GPT-5, Perplexity, and other AI models now make financial modeling accessible for anyone. But caution is essential. Junior miners can offer massive upside or collapse if funding evaporates. Disciplined research is the key.
I've seen a number of estimates of the shortage of silver at the LBMA. One estimate said there's only 6 weeks supply ahead, and another one said there's 4 months, so that's quite a big difference. But the bottom line is, it does seem that silver inventories at the LBMA have been shrinking for years. And of course, what's left is going to be very much spoken for in terms of it's leased out or it's held by an institution which has no plans to ever sell it at any price. So when you have a situation like that, and if the demand continues to be higher than the supply coming in, and by the way, there has recently been a report, I haven't read into it, but a report of big shipments from America to London of silver. But if the supply is not coming in, you then get a kind of leveraged situation when people want silver, but it's in short supply, because the leasing rates at one point I heard were up to 40% a year, which kind of means that people will say, you need silver? Borrow it from us and we'll charge you a lot of money. So it kind of implies that there were some real problems at the LBMA. But one of the funny things about if you have a high leasing rate, silver will flow in, because people say, I want to take advantage of it. So I don't know that it's the end of the game for LBMA, but what is clear is there's a shortage of silver in the market across the board. That's absolutely clear. There's no doubt about it. And that's why the price is going higher, and it has to go higher to suck out the recycled silver, because if you didn't have recycled silver, there wouldn't be enough to go around.
Silver inventories at major vaults, including the LBMA, have been trending lower for years, with some analysts estimating only weeks of available supply. Leasing rates spiked as high as 40 cents, a sign of intense stress and urgency among institutions needing physical metal. This tightness surfaced dramatically when system outages briefly halted trading, causing spot prices to jump sharply in the absence of new short positions. Whether or not manipulation exists is debated, but the real message is clear. The physical market is stretched thin. Without a sustained influx of new supply, silver must rise to balance global demand.
Tell you what I think in a second, but let's just start by saying it's never a great idea to trade a conspiracy theory.
Yeah.
So, now, in this case, it obviously was rather convenient that things broke down just at the high point, just as it was hitting a peak. And in a way, one could say that maybe gave the shorts some kind of breathing space to figure out what they're going to do without getting margin calls while the silver price was hitting all-time highs. So they can't send out a margin call in the middle of the day or think about a margin call if there's no price to make a margin call. But what we did see, which was quite interesting, during the period when the shorts could no longer roll over their shorts or do whatever, or initiate new shorts, the spot price rose sharply. I think it went up by 5.7% on the day. So in one sense, that kind of shows us what the real supply and demand might be if it weren't for what everyone suspects is market manipulation. And I want to stress, I'm not part of the conspiracy group. I don't really believe that there's market manipulation going on, but I have to accept that it is a possibility. But I think this overheating was just convenient and not necessarily sinister. But what causes overheating? Why that day and why not any other day? I don't know. There's got to be a nagging suspicion, but I'll put it down to randomness.